Today, Birkenstock Holdings PLC went public under the ticker BIRK. This is the shoe company. They try to establish themselves as a more fashion luxury shoe, but we're going to look into whether they IPO'd at the correct price. The stock dropped nearly 11% today off of the $46 that it opened up at. And we're going to see if it's worth buying and what a reasonable price may be for that. So here we have some of the information. It IPO'd at $46. They issued 21.5 million shares, but they have 187.8 million shares total. A lot of those, most of the company is still locked up with executives who have 180 days before they're able to sell. Just something to note, we are using this full outstanding shares number for our calculations though. So as they start to sell those, they start to hit the market, we would still be looking at the fair value of the stock. And it looks like the market is fully aware of this number here. When we go to our scorecard here, we see that we're coming up with a calculation of $46.79 as the fair value. So 46 is a fair value for the stock. It closed out today. It looks like at 40.20. There is no high or low because this was the first day of trading. So it's 40.20 across the board. Ideally, we'd be looking at getting into this stock closer to 30, if not below that. And that'd be a pretty big margin of safety. It is an IPO, so we'd want something rather large, 35%. What we're looking at for earnings, 3.86% earnings yield, could be higher, especially in this economy. For that, we'd be looking for around $2 in earnings, $2.12 ideally. And if you really break it down, assuming that they had this share count throughout, we'd be looking at them coming in with 177 in earnings last year and 120 in earnings this year. Would be the goal. So they are a bit low on that. It looks like next year they'd be up to 145. So it may be 3 years out before we actually see the $2 range. Cash flow yield, they're amazing on cash flow, 13% yield, up from the average of 12.2%. A dividend yield, non-existent as of yet. Their returns are not stellar. 7.94% on equity, 4% on invested capital, and assets 3.9%. We'd like to see these returns be in the double-digit range, and we are not seeing that. They are new to the market, so we'll have to see how this plays out over time. They did get a large investment in 2020, which is why some of these numbers look like they jumped up huge in that year. That was some private equity that went in and really helped them out. Debt to equity, they are in a decent place, right about that one that we like to see. Gross margins look amazing at 60%, up from what they've traditionally been around 57. Net margins 15%, up from the 13.7 that we've typically seen with this company. I had to change these instead of 2 year and 3 year. We're looking at 2 year and 1 year because we do not have all of that data. So for revenue growth, over the last 2 years, it's been growing about 13.6% per year. There are no analysts on this stock yet, so we'd like to see them come in with at least that. So we're going to put into our projections here 13%. Earnings per share growth has been pretty good. There is going to be a decline this year to next year. We'll really have to see how things play out now that they're new to the market. I mean, they have some of their old financials that I was able to use for some calculations, but we'll see how it truly plays out. This is an educated estimate. A share count, let's hope they hold the share count steady. Potentially buy some back if they feel like it's overvalued, but the stock is so new that I doubt that that's going to be happening. So we're going to hope that they hold that steady. Assets, over the last 2 years, they've been growing at 3.9%. Maybe I can bump this down to 5.75%. And liabilities right about 5%. So we'll say 5 on that. Dividend growth, non-existent dividend. That's what we're looking at there. So for our future projections, this essentially is the thesis. This is what we're looking for the company for the next 3, 5, 10 years, depending on how long you want to stay into the stock. And based on that, the intrinsic value of the company would be growing at about 11% a year, which does beat out the market, 9 to 10 on average. So you're beating out the market by 1 to 3% per year, which is that's what we're looking for on this channel. But if you were to buy in at the current price, $40.20, the intrinsic value is not at that point at the moment. So you'd be looking at a 3% return over the next 3 years in intrinsic value, of course. So if we change this to our margin of safety right around that $30 range, this is more like what we'd be looking at. You'd be looking at $11.22 in gains, so 26% over the course of the next 3 years, essentially on par with the market. And then if we adjust the 5-year number, we'd be looking at essentially on par with the market as well at 45% compared to the 47. So maybe we need an even larger margin of safety. Yes, a 37% discount, buying it at 29.5 will get you the intrinsic value on par with market growth in both 3 and 5. But their margins have been improving, which will help them over time. They've gone from net margins 12.1 to 13.9 to 15.1. And if they can continue on this trend, they'll be in much better shape down the line. So it might not be that low, but if the stock drops down to $30, it probably would not be a bad idea to buy, as long as you believe that they're going to come through with this 13% growth for at least the next 5 years. So let's see if we see anything funky in the numbers. Graphed out, 2021 looks like a bit of a dip. Nice trends across the board for revenue. COGS moving about as expected. We see a very similar trend in the gross net and EBIT, which is no surprise. Balance sheet, some nice asset growth. They are negative in their tangible assets, though. That is something that I don't really like to see. Liabilities are growing as well, about half the size of the assets, and they do have negative tangible book value. Cash flows, nothing too crazy here. They do seem very flat, just looking at the numbers. They do not pay a dividend. So this is what we would be looking for the financials that were given on the company going back to 2020. We see cash flow is usually one of the lower ones down here. The balance sheet does bring quite a bit of value. Fair value moves in line with the balance sheet for the most part. And then the earnings are what's really driving the growth here. So I would not invest at the current prices. I would definitely wait and see where the stock bottoms out. Hopefully it's around the $30 level, which would be a good point to buy in, as long as you believe that they're going to come in with 13% revenue growth as they've done in the past. Their share count isn't going to change, and they're able to grow their assets faster than their liabilities. They did say that they were IPOing to pay down some of their debt, so we could see these liabilities drop drastically. And in that case, it'd be a much better situation here, especially if they can not only pay down those liabilities, but grow their assets at the same time. The balance sheet would be looking a whole lot better too. So I'm going to watch this company. It does show potential to beat the market, and it is something new to the market of interest. So we'll keep an eye on it. I'll let you know if it does get down to that $30 level, and we'll follow along with earnings. But that's it for now. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment what other IPOs are coming out that we should look at. And subscribe so you can stay up to date with everything. And I'll catch you next time.